Did you know that only 4% of traders make it successfully? How are you going to be in that elite company and find the right stocks this summer? Welcome to the Every Chip Investing YouTube channel. I've been in your shoes. I've been trading for a long time, even before the pandemic, and I want to bring it coverage to the markets that are underserved when it comes to content. So I hope you enjoy this page. As a heads up, I'm not a financial advisor, so you must also do your own due diligence when it comes to trading. This is indeed for entertainment purposes only, and I do hold a long position in Delta, American, and United Airlines. Finally, if you like these videos, please like and subscribe so I can continue pushing out content for investors like you. And so I can also have fun on the weekends sometimes and talk about something I'm very passionate about. All right, team. So airline stocks, they've been held down for a while, whether it's because of oil prices or interest rates, the pandemic, whatever it was. But it's about time for them to take off. Pun fully intended. And by them, I do mean the big three legacy carriers. So United, Delta, American. Not your low-cost carriers, not your ultra-low-cost carriers. Here's why. Low forward PE ratios. So currently United is sitting at 5.16, assuming that they get $10 earnings per share this year. Delta is sitting at 7.37, assuming 7 EPS for 2024. And American's at 5.33, assuming 250 EPS this year. Now, these are all very conservative for 2024, considering what they did last year, as well as what their first quarter performance was so far in the first couple months, as well as the backdrop for the rest of the year. So for 2023, United had 10.05 with their adjusted earnings per share, whereas Delta was 6.25 and American was 2.65. So why are they even going to be better this year? I'm so glad you asked me that. Alright, so first and foremost, when you are trading airlines, you need to understand what's going to kind of go into what their earnings. So oil prices are dynamic pricing. So I'm always looking at the jet fuel prices, and I'm also looking at the TSA checkpoint travel numbers throughout the year. That's year over year. So looking here, every single day year over year for the month of April is stronger than 2023 year over year until you get to April 8th. And that looks like that's the only day in the whole month of April that was lower year over year. So on top of that, Delta also announced it had its 11 best sales days in its history in just the last quarter, showing a lot of strength throughout the whole summer when everyone's taking vacations, traveling, etc., etc. Yeah, these numbers are strong throughout the whole entire year too. So I'd probably guesstimate between 95 and 98%. I'd say year over year on the days are a lot better. So if we're looking at the oil price charts, I know everyone likes to look at the oil price charts because we all want to know what we're all paying for at the gas pump, right? So 86.91 on April 5, 78.53 now. If we're looking at the daily jet fuel prices, it was 273 on April 3rd, 275 April 4, 279 April 5, 270 on the 9th, and all the way down to 243 right now per gallon. So why is this significant? So when I'm looking at earnings for the second quarter, I want to know what some of the dynamic pricing is going to be compared to what the airlines were projecting for quarter two. So Delta was projecting 270 to 290 for jet fuel prices for Q2. It's been under that tremendously all quarter so far. As of yesterday, 243, and they've been decreasing steadily. If there's a ceasefire deal between Israel and Hamas, even if it only lasts a month or whatever it is, those prices are going to go down even further, which is going to mean that I think for an airline like Delta that is very conservative when they give guidance, they're going to have a trifecta for earnings come July. So trifecta means they're going to have a beat on the top line, the bottom line, as well as a guidance hike for the rest of the year. And I think that's about to come. It's strong. They already pay a dividend as well. They're not going to increase that for the next couple, I'd say 2 quarters at least, in just my humble opinion. But that dividend is going to increase by next year. So also business travel is returning. It's been alluded to in the past few months, but especially with the writer strike ending in Hollywood, auto industry renegotiating their labor contracts, and the tech industry on the West Coast returning to the office and traveling more. Delta's also said that over 90% of companies polled will maintain or increase their travel for the rest of the year. So growth in travel over the Pacific as well as Europe markets are just expanding. Because of that strong foreign travel, the big three are best positioned to capitalize because of their routes as well as their premium cabin space. Let's face it, during the pandemic, people have wanted more space in between passengers, and it started as a safety net, but now it's all about comfort and not being crammed in main cabin. So studies from the legacy carriers in past decades have shown that once you travel in a premium cabin, it's hard to go back to coach, and you're more likely to pay for an upgrade and not even leave it up to chance, even if you have airline status. And that trend is not going to end anytime soon. That's why you're going to see airlines target young travelers with their frequent flyer programs as well as their co-branded credit cards. So even if you don't know much about airline traveling, or you don't fly much with them or pay attention to their stocks, I'll make an analogy, because we all have a car, it seems like, unless you're in a big city and you just take a taxi or subway everywhere. So think about Buick and Cadillac. Buick and Cadillac had done studies throughout their lives and have re-engineered their marketing to where they are diversifying and going towards the younger generation, because they realized after decades of only selling to retirees that they'd only be able to sell them 1 to 2 cars in that individual's lifetime. If they changed their habits and they started to look a lot more luxurious and nice to the younger generation, then they might be able to sell 4 to 10 cars to them throughout their lifetime, bringing in much more revenue and much more profits. And that's exactly what the airlines are doing right now. That's why the legacy carriers have an advantage over the low-cost carriers and the ultra-low-cost carriers. It's also why Southwest is contemplating changes to their cabin configurations. American Airlines just said 80% of its revenue came from loyal passengers, which is a 10% increase from 2017. Southwest used to be the darling of the airline industry, and at this point, they are the ones who are going to have to change. Credit card remunerations are also growing. Delta had $1.7 billion in the first quarter alone. They have a long-term goal of getting to that $10 billion annually, and this is also why American mentioned multiple times during their investor update a couple months ago that they expected better revenue once it renegotiates their credit cards with Citi and Barclays. The overall margins from credit cards are much higher than passenger revenues, which is also part of the reason why American and Delta have changed their elite status qualifications to better include credit card spend. Let's face it, at the end of the day, the big three are going to reward those that bring in the most money into the carriers. And those margins from the credit card spending brings in much more than just the flying. And this is good to hear as investors, because airlines have multiple levers to pull for better earnings. And that credit card spend is going to continue to increase. You could even just look at Amex's earnings and what they report with Delta. Broader considerations for the airlines also include interest rate cuts eventually, which will likely eventually go down, no matter how long the Fed keeps rates the way they are, as well as the Israel-Hamas war. A ceasefire once again would go a long way. So another thing I'm looking at here too is airlines catching up with cruise lines, which has been a sore subject for me. So, listen, airlines have very similar CapEx expenditures as the cruise lines do. Okay, they buy big boats, airlines buy big planes. We each spend money and fuel, so the same dynamic change with their cost. Even with all this, Royal Caribbean is currently trading at 12.75 forward EPS, and Carnival is at over 14 EPS. It is time right now, guys, for the airlines to catch up, and I think we started to see the beginning of this after United had their huge bump up. In fact, let's go check out their chart right now. Yeah, right there, because I have the 30-day chart pulled up. Look at that beautiful run. And now it's starting to kind of trade sideways, and we're starting to build that base for that next leg up. All right, so with a much better Q1 for both United and Delta year over year, they're already ahead of pace of last year, and jet fuel prices are just going to continue to decline, bringing tailwinds for their stocks on their runway. Once again, pun intended. Listen, guys, I appreciate the time. Please like and subscribe so I can continue bringing you content for straight entertainment purposes. Take care.